For the small investor, the most important question to ask yourself is what mistake can I not afford to make?
Joining us now is Mohamed El-Erian, president of Queen's College, Cambridge, alongside Market Domination co-host Julie Hyman. Mohamed, it's great to speak with you. Thank you for making the time. I want to start on comments from President Trump deflecting concerns about a recession this weekend when asked about it, instead just saying we have to go through a period of transition. Where does your recession outlook stand today?
So my probability of a U.S. recession has gone up from 10% to 25 to 30%. So it's not the baseline, it's a fatter tail. The reason why it's not the baseline has to do with the structural strength of the U.S. economy. It also has to do with what we've been promised down the road in terms of deregulation, tax cuts, and the reality of low energy prices. So a bumpy journey with a growth scare, but recession is not my baseline.
Mohamed, it's Julie here. It's great to see you as always. So even if a recession is not your baseline, there is, as we know, a lot of uncertainty, and uncertainty about where the tariffs will land, if they even will land, which implies some sort of stability, uncertainty about how long that growth scare or growth shock could last. How are you thinking about these issues in this sort of timeline? Like, what does 2025 look like? What does 2026 look like?
So it looks less rosy 2025 than it did before, because we're seeing the soft data weaken. The survey data shows confidence going down at both the household and the corporate level. We're hearing more and more wait and see. We will wait and see before we make these investments, because companies are looking for clarity. And the risk is the stall speed, that too many people wait and see, and that speaks to 2026. So we'll see. There are two concerns in the marketplace. One is that this unpredictability is not short-term, it's not a bug, but it's a feature. And two, that the tariffs are not cyclical, but they are secular. Those are the two main concerns. And if they were to play out, then the outlook for 2026 would be less cheerful, if you like.
Right, that assumption that tariffs are sort of here to stick around. You mentioned the hopes that regulation or deregulation will flow through to growth at some point. That takes a little longer. And then the tax cuts is the other big question here. Even if there is an extension of tax cuts, if there is not then an additional sort of corporate tax cut, I guess what I'm asking is how contingent is avoiding a recession and or future growth on extension of the tax cuts and perhaps even deeper cuts?
So everything has become contingent, Julie. We're living in a strange world where no matter what you think about growth, and we've just been talking about the range of possibilities, there's a range of possibilities for inflation as well. So, we have both major macro variables in play right now, and it's very difficult to pin them down. And that is why you're seeing a complete upending in virtually every single consensus trade that was common at the beginning of the year. Everything in stocks, in bonds, in currencies. We've had a complete upending of the conventional wisdom.
Mohamed, you were, of course, at PIMCO, Chief Investment Officer there. And if you would this morning, I imagine that there are a lot of people who are in that position right now that are trying to figure out what their playbook is for this environment, where you're talking about this bumpy road ahead and the growth scare as well. How does that translate through to the investment strategy, both from the biggest money that's flowing around in the market all the way to an investor that is just on the retail side and trying to figure out where they need to sit and wait versus where they need to reposition?
So for the small investor, the most important question to ask yourself is what mistake can I not afford to make? When the world is really uncertain, the probability of a mistake goes up. The biggest mistake an investor can make is to be forced out of a good position by high volatility. So it's really important for small investors to understand their appetite for volatility, because we're going to have a lot of volatility going ahead. If you are a large institutional investor with the whole range of tools, then you can make volatility your friend. And you can make it your friend by being increasingly barbelled, earning high quality yields at one end and then being more opportunistic and much more selective at the other end. And part of being opportunistic is going to take advantage of the overshoots. And we're starting to see some overshoots taking place.
And for the company level, I wonder, because you also serve on the boards of some high-profile companies, the number of tariff mentions that we've heard on earnings calls, highest that we've seen in 10 years. What do you believe companies are trying to get ahead of right now in terms of making sure that they're mitigating the impact that they're anticipating at this juncture as a result of tariffs, and whether or not they will be as extreme as what's anticipated?
It's really hard. It's really hard. Because first, you don't know what the tariff regime is going to be like. Even if you knew what the tariff regime is like, which is a big assumption, you're not comfortable about the price elasticities, both on the supply and the demand side. And then even if you knew what the price elasticities are, which translates to, can I pass on the higher cost because of tariffs, or can I compete in a foreign market, even though I'm subject to higher tariffs because someone's retaliating against me? Even if you knew all these things, can you change your prices fast enough? So it's really hard right now, and that is why the mention of tariff has skyrocketed in earnings calls and certainly in the board meetings I go to.
Mohamed, what do you make of the market sort of ignoring the risk of those tariffs, obviously after the election with the huge run-up in equities that we saw, but even until we saw those tariffs on Canada and Mexico and the additional on China put into place, the market was somewhat ignoring those risks. Do you think there was a lesson learned over the past couple of weeks?
I think it was a matter of sequencing. The market believed that it would get the big bang. So if you think of the 5 areas that President Trump identified in the election: tariffs, deregulation, immigration, energy, and fiscal policy, DOGE. Those 5, the belief was that you would get a big bang so that the negative short-term impact of certain measures, tariffs, what's happening to the public sector, would be compensated by the positive impact of lower oil prices, deregulation, and a favorable tax regime. So the assumption the market made was that you would get the big bang. Instead, you're getting a sequencing where the negative effects are being felt first and the positive effects are promised in the future. And that's what the market is getting used to.
There's a question as well about whether it's the Trump administration's goal to slow the economy. And obviously, we've heard Treasury Secretary Scott Bessent talking about the desire to keep the 10-year yield as low as possible so that the Fed cuts rates. How true do you think that is?
So I don't think they want to slow the economy to get the 10-year down. I think they want to get the 10-year down by favorable supply shocks. That will bring the 10-year down over the longer term. I think what they've realized is the difference between a journey and a destination. And that's why you're starting to hear about little disturbances. That's what President Trump called it. You just mentioned the Treasury Secretary said detox. There's this notion that there may be some bumps along the way, but the pain is worth the gain down the road. And I think that is the new narrative coming out of Washington. And the marketplace is just understanding that the sequence of these 5 measures we talked about is not simultaneous, it's sequential.
Mohamed, we keep talking around all of this transformation, the transition that this administration wants to see for this economy. Do you understand the vision of what they're trying to achieve? Like, what are we transitioning to? And is it worth it? Because clearly they keep talking about pain. The economy was doing pretty darn well before all of this started. Is this a pain that is worth inflicting to achieve whatever they're trying to achieve? So I guess first, what are they trying to achieve?
So from what they've said, they're trying to achieve the following: a fairer trading system so that US goods are not discriminated against in global trade. Second, they want to detox the economy from its high dependence on the public sector. They want to shift from a public sector driven economy to more of a private sector driven economy. Third, they want to enhance the efficiency of government. They want to make government not just smaller, but more efficient. And then fourth, they want to unleash the private sector through deregulation and favorable tax treatment. So that is what they're aiming to do. So at the end of the day, what they're aiming for is a more efficient economy driven more by the private sector than the public sector, that operates in a fairer trading environment. But as you said, getting there is hard. And if you hit stall speed, which is, so to put numbers to this, last year the US grew by 2.8%. The consensus forecast for this year's growth is 2.5%. When we get the revisions, which we will, it would not surprise me if we go below 2%. Somewhere below 1.5% to 2% is where we'll end up. Stall speed is about 1%. So we're getting closer to stall speed. And if we get to stall speed, then the journey becomes too difficult for the destination. And that's going to be the big question, Julie, as we look forward.
And we haven't talked much about the Fed's role in all of this, but as we mentioned, you did write in a commentary piece where you talked about what you see as the need for the Fed to change its inflation target, to bring it up above 2%. How urgently do you think they need to do that? Why do you think they need to do that? What will that achieve?
So let me just say they're not going to do this. In fact, Chair Powell had said it's not on the table. He doesn't want to even talk about it. I think that's a mistake. You've seen what's happened to surveys of inflation expectations that have gone straight up. The world understands, people understand that we are the structurally changing economy. We were even before tariffs, and we are now in a sort of turbocharged, structurally changing economy. If you try to run monetary policy too tight, then you will get to stall speed. The Fed becomes not a stabilizer, but a contributor to economic volatility. And I think that is the main concern. Now, the good news is the Fed is saying one thing and doing the opposite. If the Fed truly believed that they could get to 2% on the inflation target in a timely manner, we would not be talking about how many cuts next year. This year, we'd be talking about when is the next hike. So I think the Fed is saying one thing and pursuing the other. What I'd like it to do is over time, transition to a more sustainable regime.
Mohamed, do you think that fiscal policy will end up forcing the Fed's hand? I mean, Jay Powell has sounded very patient, but given the perils of potentially slowing to that stall speed, do you think the Fed is going to have to act and cut more quickly than it would otherwise?
That's certainly the market expectations. The market has gone from one cut this year to expecting at least 3. So the market thinks that the employment part of its mandate, of the Fed's mandate, is going to force the Fed to cut. We're going to see CPI on Wednesday. We're going to have more inflation data over the next few weeks. We need stable inflation in order for the Fed to respond to the maximum employment part of its mandate. Otherwise, they're not going to deliver the 3 cuts.
Mohamed El-Erian, thank you so much for taking the time here with us today, as well as our own Julie Hyman. Great to see you both.
Thank you.
Huge sell-off, $1 trillion in value lost off the NASDAQ 100. Just want to get your take. Why yesterday? We've had these tariff concerns. We've had these recession concerns. Didn't seem to be any big economic reports or anything out. Why do you think it happened yesterday?
What's the rules of the game? In other words, from a macro perspective, in terms of tariffs, in terms of China export controls, I think that's really the one that's getting the tech trade nervous. Because when you look at export controls, what does that mean for Nvidia? See chips selling off, AI revolution, a lot of those trades. And I think that, look, I think you're seeing, I believe the nervousness that I'm seeing, I'd compare to maybe some of those days even during COVID, in terms of March 2020. I'd say that level of nervousness, but I believe it's misplaced relative to where I view the fundamental stories playing out in tech.
Yeah, but I mean, have we known about those export controls for a while? I mean, it just seems like Monday, everybody started to believe that all these things were going to happen, tariffs, export controls, and did they just all of a sudden realize that the consumer is also stretched, which hits a number of these names?
Well, I think also maybe like some words about recession, you know, what does that mean for the consumer? Every data point sort of microanalyzed. Look, what I believe, especially in tech, look, valuations clearly are expensive if you don't believe what ultimately growth is going to look like. And I think right now, look, you're going through a gut check period for tech stocks. But I believe this is not the time to hit the exit run for the hills. I think you look at the winners. I think we navigate through, I'll call it an uncomfortable time for growth. And I think that's where the opportunities are.
I just want to be clear really quick. We were talking about the one thing that concerns you. It's the export controls. You think that's kind of the catalyst for some of this downturn. at the same time. I mean, you're known as one of the biggest bulls when it comes to tech on the street. A lot of times, we have a little fun. You're talking about what time it is in the AI party. This is, like you said, a gut check. But I just want to talk to you about the fundamentals. You often talk about we're in a 10-year cycle when it comes to the AI build-out. Do you still believe that that cycle and that story is still intact?
Yeah, and look, we're in year 3 of what's essentially going to be an 8 to 10 year build-out. The reason those export controls, it sent such really nerve, throughout the tech trade is that that's something that when it comes to supply chain, when it comes to a lot of the build-out from Nvidia, when it comes to the data center point, but I believe bark's going to be worse than the bite, and this is not the time that in any sense for me, we sort of peel back on the bull thesis.
I just want to kind of just go a little bit broader. Let's talk about something like the IGV, software.
Yep.
That seemed to be taken off in the early part of the year, but I'm looking right here. It pulled back more than 5% yesterday, not subject to those same export controls. A lot of their customers, when we're talking about the IGV, they're enterprise customers, not necessarily hit by the same impact from consumers. Why are we seeing that pullback? Why are we seeing the ARK Innovation ETF pulling back?
Sure.
Why are those things pulling back on that story of export controls and tariffs?
I think it's worrying about the self-fulfilling prophecy. In other words, if enterprises cut back, does any sort of that AI spend, that cloud spend sort of cut back? When you look at Oracle last night, Oracle strong in terms of data center, in terms of AI spend. But Frank, I just think right now we're going through one of those periods where good's bad, bad's worse. But that does create the opportunities for the names you want to own.
As we're looking at this, what seems to be a rotation away from these Mag 7 names, we're going to talk a bit more about that in just a second. We're going to talk about what's coming up. But first, I want to go back. DeepSeek, is that still hanging on the tech trade? Is that still impacting some parts of this?
I think lingering, but I do think as more has come out about that, I think that maybe the less nervousness in terms of what that means in terms of Nvidia and the overall build out. But it does speak to, is there a decoupling going on between the China trade and U.S. tech trade? And I think that's something you're even seeing in terms of in Hong Kong and more of the focus on China tech. But no doubt, I think DeepSeek's out there, and it puts more pressure in terms of Beltway, export controls. Is that a shot across the bow? I think that's how you sort of tie it all together.